The gentleman's yielding me his time in order to be expeditious. Madam Chair, I want to be brief also, and I've got just a series of short questions. First of all, from the standpoint of the FDIC, looking back now, wasn't, forgetting about whether the merger was a good merger, the MAC, all the other things that this committee has worked on, wasn't the underpinning of the additional money, preferred stock as a form of loan, wasn't that in fact the most appropriate thing for the FDIC to approve of so that the capital worth of Bank of America would be undeniable?
Well, I think it's always hard in hindsight to answer questions like that.
Actually, I normally find it easier in hindsight. I'd hate to have
maybe easier in hindsight. Well, I guess it's easier to reevaluate decisions that were made. I think a distinction needs to be made between the insured depository institution that had a strong capital position with other activities that were going on in the bank holding company. And so I think if you're looking just at the insured depository institution where we had the exposure, there's a question about whether additional capital was needed. I do think that.
No, and I'm not saying whether it was needed. It's clear that in hindsight, right, it's clear they didn't need it because they paid it back to you essentially without it being from actual new money in any large amount. They passed the stress test, and they passed the stress test and said they could pay it back. Mm-hmm. So I know that part of hindsight is clear. Right. But the real benefit of the $45 billion of loan, and I repeat, it's not, we didn't bail them out, we didn't give them anything. Right. We bought stock, we bought the worth of the company, right, and we got interest guarantee and the ability to get our money out ahead of everyone else. Preferred stock is not all bad. Right. But the effectiveness of it was to, if you will, over-capitalize the company in hindsight. But wasn't that essentially a good thing in that if there was no other benefit to TARP, the confidence of knowing that these particular banks were extremely well capitalized, not as to the stockholders, right, but as to the depositors, wasn't that effectively the good thing that came out of this arrangement?
Well, I think, yes, the capital investment certainly created a fortress balance sheet. I think that was the original intention of all these capital investments under TARP. Again, we were not, the only role that we had was on the ring fence, not on the TARP investment. That was a Treasury program, a Treasury decision. But yes, certainly.
Okay. But you were the beneficiary of it in a sense.
Absolutely going to have a stabilizing impact, yes.
The next question is the harder one. Many banks and many non-banks decided to become banks conveniently in this crisis. Right. Many entities, in fact, fled to the FDIC, and the FDIC finds itself with its funds which are designed to ensure that we never have to actually put in taxpayer dollars. Those funds are stressed right now. Going forward, do you believe that, in fact, in the future, people should be able to run to the FDIC, run to being a bank when it suits them, even if they hadn't been when it didn't suit them?
No, I don't think they should be able to do that. Absolutely.
Is that a reform that you presently see on the horizon that would give you that ability next time to say, you better be there early or not come at all?
Well, I think two things. I think we need a robust resolution mechanism so when entities get themselves in trouble, they don't get government assistance, they get put into receivership. And I think entities asking for assistance maybe won't ask for assistance so much if they know that that is the repercussion. In terms of entities becoming bank holding companies and having insured depository institutions, not just for deposit insurance, but for the Fed lending facilities, we have suggested that there needs to be a systemic risk council that would decide and have the power to say to an entity that became a bank holding company, but perhaps later doesn't want all the regulation that entails, that they still need to subject themselves and be subject to prudential supervision, that they can't arbitrage just becoming a bank holding company when it suits them and then not, and escaping the regulation when that suits them. Absolutely.
Thank you. I yield back to the gentleman from Arizona. And he yields back.